G'day, ladies and gentlemen, and welcome to another cracking edition of Investing in the US, an Aussie's guide to US real estate. From Los Angeles, I'm your host, Goossens. Good as always to have you with us on the show. Now, it is a new year. It's 2018, and it's going to be huge, and I'm glad you've all tuned in to listen to my incredible guests. And the reason that I do this show is to educate you about the awesome benefits of investing here in the United States, in real estate, in business, and as an entrepreneur. And hopefully, my guests will inspire you to get off the fence and go out and take massive amounts of action. We're all about educating my guests, my listeners on this show, and increasing their financial IQ. And you know, this show is all about sharing the knowledge. There's absolutely no BS. And if you do like this show, please give us a review on iTunes. It only takes two seconds to jump on there and show iTunes that we're providing some incredible information for you to go out there and start scaling your business and take action. If you do, you can also find me on wherever you podcast, on iTunes, SoundCloud, Stitcher, and Google Play. And you can also find these episodes up on my YouTube channel. Head over to readgoossens.com and click on the podcast link. It will take you to the video recordings of these shows each and every week. You can see my ugly mug, but you can see the beautiful faces of my guests that I have. All right, enough out of me. Let's get cracking into today's show. Today on the show, I have the pleasure of speaking with Noe Perrin. Noe is a real estate consultant focusing on helping investment firms scale up in terms of their underwriting and financial analysis capabilities. Noe offers his clients a one-stop financial underwriting services, and you can think of Noe's business as like having a personal assistant. We're going to be chatting all about the importance of having the proper financial underwriting systems in your business in order to scale, but in order to attract institutional level investors to your deals. But enough out of me. Let's get cracking and into today's show. Sorry, I'll have to do that again. But enough out of me. Let's get him out here. G'day, Noe. Welcome to the show. How you doing today?
I'm doing great. And you, Reed?
Good, mate. Good. I'm really glad to have you on the show. I know we've been working together for some time now, and I've been really excited to get you on to just share the knowledge that you have with underwriting, because you're one of the most smartest guys I know in the underwriting space. And I'm not just saying that to butter you up, but I'm also saying it because you are very knowledgeable about what you do. But before we do dive into the nuts and bolts of today's show, can you rewind the clock and tell us how you made your first ever dollar?
Sure. So I've always kind of been a little bit of an entrepreneur. And so the first way that I ever made my dollar was selling candy in high school. I heard a lot of people do it. And yeah, it was great.
Mate, I was interviewing someone last week, and he did exactly the same thing. You go to Costco or something, buy it from bulk for 10 cents. You go to school and sell it for 25 cents. You make a profit of 15 cents. It's fantastic.
Exactly.
But tell us a little bit more about your journey, how you got involved in real estate underwriting and financial analysis, and particularly, the types of, what intrigued you getting involved in the real estate space?
Sure. So while I was in, high school and things like that, I was very interested I got in obviously from selling candy, and I was buying, making a profit. And then with the profit, I would go back, buy more and sell. And so I was growing the wealth, so to speak, like that. And so I got interested in investing. And then what happened, similar to you, is I moved to the US to go to college.
Right.
And so that's actually when I discovered real estate, just going into the library. And that's how I found out about it. And so I started at a very low level, but thankfully I was always interested in investments. So I started just, doing an internship at a real estate brokerage, making $100 a week. And it just kind of started growing from there. I did a couple other internships, and always I was just trying to get better and better at being able to analyze deals. And so I did start a property management company while I was in college for a little while. But that was very hard, and property management is very operations intensive. Mm-hmm. So I decided to go back to what I'm good at, which is, being an analyst and running numbers and helping other people grow their business through best practices and underwriting.
Yeah, and I think that's such an important thing that, it sounds like you've gone out and maybe tasted all the different options you can taste in real estate in terms of property management, underwriting, working as an intern in a financial institution, and then really honing down the fact that your skills are really in and around financial underwriting and then developing a business around that. So do you want to talk to us about, let's get into the nuts and bolts right now. Let's start at like a 30,000 foot level. Mm-hmm. What is the importance in your mind of having the proper not just the basics, in your real estate business, the underwriting, but why is it so important to have an institutional level type of analysis or someone in your team that can analyze deals in that way in order to attract capital?
It's hugely important so first of all, it's almost counterintuitive, but sometimes it seems that almost the presentation of the numbers a lot of the times is just as important as the numbers themselves.
Right.
Because everybody judges a cover by its book, even though they say that they don't. And so first of all, you do need to have all your numbers right, because institutional and sophisticated investors will challenge your assumptions, and they will also underwrite the deals on their own behalf. And so if they don't think that what you're saying is going to happen will happen, they're going to question you, and then it's going to be up to you to convince them that, no, my assumptions are right, all my calculations are correct, and this is what we think will happen. And people will begin to trust you just because they know that, your analysis is sound.
Right.
And so it's just builds trust.
Yep.
Really.
No, I think that's incredibly important in what you said of, not judging a book by its cover and putting your best foot forward first. I know that I've personally seen some underwritten deals which looks like, a sophomore at college could have created, and I just know that if you try to raise millions and millions of dollars, that's not your best foot forward presenting like a one-page spreadsheet on, it's simple and I get it, but from a complex underwriting analysis, you need to take, up your game, right? And that's, I guess, where, why I work with people like yourself, Noe, because you help me in my business up my game. So let's talk about the process of how you like to, when you see a deal, what are you doing? What are the steps you're doing in order to, from start to finish, to truly underwrite the deal and analyze the deal in a way that you've left no stone unturned in order to make sure that your assumptions are correct, in order to make sure that you have a sound investment and that the risk is reduced for your investors?
Right. Okay. So it really, first of all, you need to get as much information from the seller. So I work in development, so it's a little different day to day, but if you're acquiring an existing asset, first thing that you need to do is, if you're starting to engage them, you need to get as much raw data and as much information as possible. So you need rent rolls, you're going to need operating expenses, copies of the lease, as much information as possible, any reports, just to start.
Right.
And then first, you kind of get an idea of what the property is, what it's like, what kind of tenants are in there. And then I kind of like to do kind of like a top-down approach.
Sure.
Which is you start with the biggest macro, basically. So if you're international, let's say you'll start, okay, how is the GDP of the US growing? What are some of the basic trends that's happening? Okay, everything in the US is positive. Well, that's good. Then we'll look at maybe the state, at the city level, what's happening there. And then you start to really drill down into a property. So usually when I'm underwriting a deal with somebody like you, Reed, who does a lot of value add multifamily, I already have a lot of the context down.
Right.
Then it starts, you get the rent roll, you start analyzing that. Is there a lot of vacancy? Are a lot of leases expiring? Are they below market rent, above? Do they have a lot of pet fees, things like that? Then you need to look at the expenses. The expenses are going to tell you a lot, because either the expenses are really high in some categories, and so that might tell you there's some structural problems, or they're really low, which might tell you there's some kind of deferred maintenance. Mm-hmm. And then that's going to inform you for the next stages. When you go to the property and actually visit it, you're going to know what to focus on, because it's going to be very hard to go and focus on everything. Right. You just can't do that, right?
Right.
So that kind of informs you at the property level. And then it's also very important to look at the comparable properties and start determining, especially if you're going to do a value add kind of strategy, what are basically like the upgrades, or what rental level can I get to given, the age of my building, given the amenities it has, what can I upgrade, what can I not, what makes sense to upgrade on the interior or not. So I think that kind of,
yeah, that's great. So you're starting, just to recap, you're starting at the 30,000 foot level of any, market. You mentioned the United States. You're drilling down into the state level. You're drilling down into the sub market, and then you're drilling down maybe even further to maybe the street level and saying, okay, well, this is north of the 510 or it's south, and then from there you're looking at the data from the physical property itself, like the rent roll, like the P&L. And do you want to just maybe summarize maybe the top 5 things you look for in a rent roll and a P&L in order to maybe they're red flags?
In the rent roll, I guess it's always if there's too much vacancy, or also if you're seeing that leases are not going like 12 months basically, or you see sometimes in the rent roll data, it depends on how much information they collect, but you'll see the lease start and the lease end.
Yep.
If you're seeing things that have no lease end, and also if you're seeing lease starts that are really far back, it probably means that they have a lot of month-to-month leases, or tenants that renew and they don't sign paperwork. So that's telling you, it can be a good thing because it tells you people are staying for a long time, but it can also be a bad thing because they're doing month-to-month leases. It's not a good management practice.
Right.
On the expense and P&L side, I guess just you got to go line item by line item and just see what sticks out, and just mostly that.
Right. And I know that sometimes operators, or particularly, folks that have had the property for a long period of time, maybe classing CapEx dollars in repairs and maintenance, or in certain line items, which you as the business owner or the potential investor, your business plan is to nullify or reduce those repairs and maintenance because you're going to put hopefully a lot of CapEx into the budget. So do you ever see where you can reallocate dollars, say, okay, well, this particular property, this person's got 2 or 3 lines of painting or plumbing repairs or something like that, where you could potentially group those and put them in the CapEx budget and say, okay, with my CapEx dollars, I'm going to address those issues like paint the exterior of the building, deal with the plumbing issues. And then so on a long-term basis, I don't have that ongoing pain in my ass, essentially, because it reduces those year-to-year expenses.
Not only that, but that might be a good strategy to actually increase the value of the building, because if you have some CapEx expenses in your operating expenses, then your net operating income is being artificially reduced, and most multifamilies being valued based on the NOI divided by the cap rate. So if you can get that NOI a little bigger by reducing some expenses and removing some operating expenses and categorizing them as capital improvements, you may be able to add value to the property.
And you raise a great point, because a lot of people in today's hot market, and particularly multifamily, are talking about entry cap rates versus exit cap rates. So, you made a really good point that, your entry cap rate is obviously which is, for people out there who don't know, is NOI divided by the purchase price, right? And if your NOI is low, then obviously your entry cap rate is low. But how much emphasis do you put on that entry cap rate from a business model and a business plan point of view, knowing that you may have other comps which may be well above that particular asset?
So obviously it's going to depend on your strategy a little bit. But so if you're buying something where you're buying it as is and it's fully renovated and there's no value to be added, then the going in cap rate is pretty significant. However, when we're doing, these kinds of deals that, let's say, have a little bit more juice to them or profit potential, the going in cap rate can be a little bit misleading, because if you're buying an asset that has a lot of vacancies, mismanaged, is barely profitable, then of course the NOI is going to be low, and your going in cap rate is going to be also low. But so what you might want to look at is, say, the stabilized cap rate. So what is the cap rate after, we raise rents, lower the expenses, and that typically is going to be much higher than when you're going in.
Right.
And so, yeah, it kind of depends. But if you're doing value add, it's less important. It's more important you look at what would your cap rate be 2 years from now. Say.
Right. And then would you then compare that cap rate once stabilized to, say, the market? Surely that would have to have some correlation, right?
Yes. So, real estate is becoming more and more efficient, which means it's harder and harder to find deals.
Right.
So even if there is a lot of even if there's a lot of work to be done, you should be compensated for that. So you should have a higher cap rate when it's all said and done,
right?
Versus, say, the average based on what your going in price was. So yes, it should be at least 1%, maybe 2% higher
after you stabilized.
After you're stabilized, because
right.
It's a lot of work. You need to put in. If you're doing rehab, typically that gets paid for in cash, not in debt.
Right.
There's a lot of things.
No, and we're going to get into those risk factors and stuff like that. But when you determine, going in cap rates versus exiting cap rates, because again, we're underwriting these deals. Is there a rule of thumb that you like to use in terms of cap rate expansion? Everyone talks about this word cap rate expansion, because no one knows where the market's going to be in 5 or 6 years' time, and we haven't really had a quote unquote recession yet since 2008. So everyone's sort of a little bit cautious. What's your rule of thumb when it comes to cap rate expansion on the exit of an asset?
Right. So this is a very interesting question, because obviously interest rates are rising right now, and maybe we're getting late into the business cycle. And I work in development, and a development project takes 2, maybe 3 years to do. So I'm always fighting with my coworkers about this. They're like, cap rates don't move. I'm like, no, this is something that's very serious, because even if you add value to the property, if cap rates go up by a lot, basically the valuations are going to come down. And so hopefully you add enough value that even if the cap rates go down, it kind of evens out, but it's no guarantee. So right now I'm pricing in, it kind of depends, but usually about 1% more than the cap rate today, I think is a good estimation.
100 basis points, right, over a period of
points in the next, say, 3 years. What I would do is just try to, there are different estimates out there for what the Fed funds rate is. So right now, I believe that's at 1.75. So if you think it will go up 1%, if you think interest rates are going to go up by 1%, just assume cap rates will go up by 1%. Because there is a correlation there between cap rates and interest rates. Yeah.
And what is that correlation for the layman investor who's listening to this show, that you got to look at interest rates and where they're tracking versus cap rates? Why is there a correlation for those people out there who don't?
So basically, this is cool. I'm actually doing a master's program and we cover this, which is good. So investors in general have a wide range of investments that they can choose, right? And so a lot of capital is risk averse, and they buy treasury bonds, which basically pay an interest rate. So to entice the investor to go from the treasury notes, which is risk-free, to real estate, they need to be paid extra. They need to be paid a real estate risk premium. And the stock market also has a stock market risk premium. So in the big scheme of things, basically, if that risk premium for real estate stays about the same, every time that the real estate every time the treasury rates or interest rates go up, so let's say they go up by 1%, everything else should track the same and also go up by 1%, that required rate of return. So that's kind of.
And why would the treasuries be shifting over time? How does that correlate to, you're talking about risk adverse capital, look at the treasury rate of 1.9%, and you think it could go up to 2.3 or whatever it might be. what's forcing that to go up, which is because this all obviously leads back to our real estate investing question about exit cap rates, because whatever's forcing that up is obviously going to force the cap rates up and also enforce interest rates up, which forces cap rates up. So like you got to nail down into why would that be shifting over time for those people out there who don't know?
I guess fundamentally what's driving everything is interest rates. And so interest rates move based on the Federal Reserve here in the US because they control the money supply. And so their biggest concern is they're very averse to inflation, which is basically when the purchasing power of your dollar is eroded. So things essentially when prices increase too much. And so the way that they counter that is usually economic expansion occurs through businesses borrowing money to invest, to build a power plant, which creates jobs.
Right.
But as a result of that, there's lots of new money entering the system, which kind of devalues the value of money. So the Fed will kind of try to counteract this inflation by raising interest rates so that businesses and real estate investors will borrow less or more conservatively. And so that new supply of money, and let's call it almost an overshoot or overheating of the economy, gets tempered.
Right.
Yes.
That's a very, very good explanation. And then for everyone, it's essentially, to summarize, it's the Fed's way of curbing inflation and trying to restrict businesses from, if it costs more to invest because your interest rates are higher, you may not be as bullish on investing. So just controlling that inflation price and the growth of the economy, essentially, right?
Yes. And also, to give you a very simple answer, as to when interest rates rise, why does real estate typically valuations come down? Because it's more expensive to borrow debt, and real estate is, 50, 80% funded by debt most of the time. So if your debt is more expensive, you need to buy a cheaper piece of real estate to still make the numbers work. Right. So,
and then there's another, we will get into some academic stuff here, because I love getting into I'm getting into the weeds, the nuts and bolts. But the difference between cap rate, this goes back to our cap rate question, the difference between cap rates and interest rates. And I know on development projects, it's very important to have a good spread, right, between your development cap, and we can talk about development cap in a second, but just in terms of existing multifamily assets, in order to establish cash flow, what is that spread between, where the treasuries and, where the 10-year note is, and where banks are lending, and where you want to be with your going in cap rate or your stabilized cap rate, for example?
In development, for example, it's 150 basis points, so 1.5%. If you can get that much spread, I think you're going to cash flow fine. Obviously, the more, the better.
Right.
But if you're borrowing at 4.5%, you should have at least a 6% cap.
Yep.
6.5%, would be better.
Now, that's on development, or is that on existing multifamily? Because there's two.
I would say on existing as well, because at the end of the day, in development for multifamily, the strategy can be to sell, but the strategy can be to build, use a construction loan, which is pretty expensive. It'll be like 8, 10, 12% debt, and then refinance into a cheaper loan. Right. That would be like a permanent loan. Which would then
cash flow, and which would then be able to produce the returns for investors. Now, this is all very interesting and very important stuff when you are underwriting deals, because it goes back to my original question of entry cap rates on existing multifamily. It is based on NOI, and if you, for example, have a 5% going in cap rate, but that the business model is to get it to a stabilized of a 6% or a 6.5% in a year's time or 2 years' time, then that fixed rate of interest rate of 4.5%, there's that spread, right? And it goes back to my original question, Noe, of how do you view those going in cap rates and making sure you're not like, 5%, no, yuck. But you've also got to be confident on your business model that where you can push that NOI to in a year's time or 18 months' time to get that stabilized cap rate. So going in cap rate, stabilized cap rate, exit cap rate, interest rates. So there's sort of four major things that you need to understand from a business plan model in order to ensure that you have capital preservation for your investors and all that sort of good stuff. Do you want to add anything to that, what I just said?
No, I would just say, bouncing off of you, you need to have these data points. Right. And so if you don't have them all, then you're somewhat blind.
But it also goes back to what I asked the first question, which is why is it so important to have an institutional level model and have those questions and those assumptions? Because if you can't answer those questions from an investor with, okay, this is the going in cap rate, this is the stabilized, and then this is the exit, and this is where interest rates are at. And we're getting, it's all about risk at the end of the day. And I guess this segues into my next question, Noe, is what are the big risk items from lending we talked about, obviously going in cap rates. I think we've covered that to death. But what are other, things that you can pull on the levers in order to reduce risk in your underwriting? And then essentially reduce risk on the overall deal and the capital in that deal?
That's a really good question. So like lots of real estate investors say, you make your money when you buy.
Right.
So you gotta make sure you're buying hopefully below market so that if you do need to get out, you can get out and maybe just have a few scratches, but nothing too serious, not lose a limb. I think in today's environment, it's really, I guess you need to double check that you can get the rents that you're saying that you're going to get, because that's really the driver. And then I think it's the exit cap rates is huge. Make sure, what we like to do where I work is we do a lot of sensitivity studies. So we'll say, let's say we think maybe we can get out at 6, or maybe we think we can get $100,000 in rent per month. We need to run a scenario where, let's say we could only get 80,000 and per month, and we thought that cap rates went up slightly more than what we anticipated. Where are we gonna be? And so we'll create like a matrix, right? Where it's like cap rates really low, really high. Our income is really high, really low, and create some bounds and just analyze and make sure that even in the downside case, you're not losing money.
Right. And I guess that's really important for all those people out there listening, is establishing your sensitivity analysis. And that's why having a basic one-page spreadsheet is just a snapshot of one scenario. Investors like to say, okay, that's maybe the best scenario. What's the worst case scenario? What happens if my vacancy spikes and my NOI, dips by 1% a month or whatever it might be? How does that look? What happens when my exit cap rate expands? How does that affect the investor's return on capital? And that's really important, right, Noe? It goes back to what we were saying before, having that professionalism in your underwriting, having those sensitivity analysis as a display in order to give a peace of mind to your investors, right?
And I'll tell you one thing, a lot of people's financial models only have straight line assumptions. Basically means let's say you have your rent growth and you make it 2%, it'll be 2% the whole way, and we'll put our expense ratio and it'll be 38% straight.
Right.
Sometimes it's good to, like you said, we got to create stress tests. So something that we've done together even is have assumptions that change over time.
Right.
Where, in the first 2 years, say maybe we have a little bit elevated vacancy and then it stabilizes, or, let's model what would happen if we had a recession and then a recovery.
Right. How does that look? Yeah. And I think that's
look and things like that.
And it goes back to that judging a book by its cover. If you can present, scenario 1, which is the best case scenario 2, scenario 3, a handful of scenarios to an investor straight off the bat, you look professional. You've answered their questions in terms of the risk of what's going to happen to my capital if something goes wrong. So there's that piece, and you give peace of mind that you know what you're doing. And it's not like, okay, let's look at all these scenarios, and I've analyzed all these scenarios because I don't know. Because at the end of the day, it's a projection, right? We don't have a crystal ball. We're not trying to create a crystal ball, and we're just saying this is our opinion of where the market's going, and this is our sensitivity analysis. And again, goes back to that professionalism, right?
100%.
Yeah,
I agree.
Cool, man. So what about with the financing, side of it? Getting lower leverage and making sure you're not too over leveraged in a deal, because that can also add a lot of risk to the deal as well. Like you mentioned before, we talked about why interest rates go up in order for the feds to curb, growth in an economy. So if you're at like 85% leverage, that's kind of scary, right? And you got to look at that side of the coin as well, and how that could potentially affect the deal moving forward.
Yeah, 100%. You got to think, there's two big things, I guess, in the loans. One of them being if your loan is a fixed rate loan or a floating rate loan. So if it's a floating rate loan, if interest rates go up, your payments are going to go up.
Right.
Which you could find yourself in a pickle, not being able to make payments.
Good old pickle.
Yeah. I hate pickle juice. So
what about a pickleback shot, man? Come on, it's good. After a long day at the office, underwriting those deals, you got to have a few pickleback shots at the bar. Sorry, I interrupted. Keep going.
So there's that, and then there's also leverage. Hold on, I gotta charge my laptop. And then also the absolute amount that you're borrowing. So like you mentioned, if you're borrowing 85% of your loan, of the purchase price on debt, A, your payments are more, B, you own more, there's more debt on the deal. So let's say you're 85% levered. If prices go down 15%, that's it, you're out of the game. You lose all your money. Now, if you went into 50% debt, now prices would have to come down 50% for you to be wiped out. And getting foreclosed on is literally the worst thing that could happen to you, because once you've lost all your money, that's it. You can't get it back. And so it's much harder to recover from a loss.
And I will add to that is there's obviously, being quote unquote underwater, and what does underwater mean? And underwater means that the value of the loan is more than what the property is worth. Now on single family, it can be really, that's why single family can be a little bit more risky if you're having it as a rental portfolio, because you have one tenant. If that tenant moves out and the value of that asset goes down, you could be underwater. And that's why multifamily or commercial real estate is viewed as a business, and they drive the valuation based on that NOI like we've just been talking about. But again, that NOI leads to how much, you've got to look at your debt service coverage ratio. And that's another thing that banks look at, right? And so you've got to, if your debt service coverage ratio, which means the remaining money left over, or your NOI divided by your debt services, if there's a gap there, typically banks like to see around 15 to 25%, then you know that your NOI is safe, and so your cash flow is safe, and in order to pay back the debt on the property, and so you don't then lose the property in foreclosure or something like that, right?
And something about being underwater, there's some commercial loans where if you're underwater where the property is worth less than what you owe, in some cases that does trigger like a technical default.
Right.
That's just something you want to avoid.
Yeah, exactly. It's something that is, we talk about recourse and non-recourse debt and how that works. And you could talk about a whole podcast about the differences between the two of them. But Noe, I know that you are very extremely knowledgeable about what you do. And we've been working together for some time now. But where can people, reach out to you? I know you've got your own podcast, your own YouTube channel where you educate people on what you do. Where can they reach you?
Sure. So the best way to reach me is honestly through YouTube. If you want to learn more about real estate, I have some free videos that teach you a little bit of underwriting, and I'm working on a course too. So I guess just go to the show notes and go to the YouTube video and find my name and search it on YouTube. Also on Instagram if you want to send me a message. And yeah, so I help, people like Reed, developers, other guys who are, doing syndications, who are buying apartment complexes like that. And I kind of help them on the underwriting, help them, give them a model, a spreadsheet that is complex, that has everything that they need. And in some cases, I also do some investment presentations and underwriting because like we said, professionalism, the looks is very important, especially if you're raising capital, and the analysis needs to be sound, or you could find yourself in a pickle.
One of those pickles again. But Noe, at the end of every show, I always like to ask my guests to give me their top 5 investing tips. You ready to get into it?
Yes.
Let's do it. All right, mate. What is the daily habit you practice to keep on track towards your goals?
Daily journaling, first thing in the morning.
Yeah. What do you use? Are you a top, a to-do list type of guy, or are you just like getting stuff out of your head onto paper?
So I do a little bit of both. So I like to just, write about, I guess, your feelings, the different ideas that you have. I like to do it early in the day because otherwise later in the day you get so bombarded by information.
Mm-hmm.
And and to-do lists and calendars and things like that. You got to organize your mind and yourself first.
And I think it's so important that you just said you've got to organize your mind, because getting it out of your mind onto paper means it declutters your mind, and it enables you to take on more stuff because it's on piece of paper. You've written it down. Okay, I'm going to come back to it. Oh yeah, I need to do that thing. And you've reminded yourself to do it. You don't have to have the stress of constantly having it in your mind, which then clutters, your focus and all that sort of stuff. Who's the most...
And you'll forget.
Well, exactly. You'll forget it, when writing it down on a Post-it note, but having a place where it's consistent and you're doing it every day helps people, and helps me. It's helped my success dramatically by doing it. I started journaling two years ago, and it's just helped me just really prioritize my day. And it also it's a nice little win. Like when you cross off a to-do list, something off a to-do list, I should say, it's like a little reward for you. It's like, yes, I achieved 6 things today. That's really awesome. 6 major things that I wanted to do. And as the time goes on, I've found that those things that you achieve in every day get larger and larger and nearly become goals. You're like, oh, wow, I achieved that goal this week. That's fantastic. So I always talk about goals to list and how you make the jump. But Noe, who has been the most influential person in your career to date?
It would probably be the author of this book called Awakening the Financial Genius Inside of You.
Mm-hmm.
Because it was one of the first books that I read on real estate, and it just like opened my mind. And I love the title as well. And so, I would attribute it to him.
Great. What's the most influential tool in your business? And it may be Excel, but maybe you have another cool tool, whether it be hardware or software, that helps you grow your business and helps you keep on top of things.
It's hard for me not to say Excel, because Excel is like, it's a blank for me, it's a blank sheet of paper where you can create anything. I've created spreadsheets that track, my life goals. I've created spreadsheets that manage my stock portfolio or real estate. So it's got to be Excel just because it's so versatile.
You're like an artist, mate. It's your canvas, and you go on and create your masterpiece, right?
It's kind of Excel is almost like programming. There's just so many things you can do with it.
100%, and that's the power of having someone in your team. If you're not really good at Excel or you don't understand it as much, it's why having people like Noe on board. You don't have to be knowledgeable. You need to be somewhat knowledgeable about Excel, but you can hire people to, again, increase your real estate business and scale up and have great underwriting models in order to attract that capital. So if you're not too financially versed in Excel, then ask people like Noe. Noe, what's been the biggest failure in your career to date, and what did you learn from that failure?
So the biggest misstep that I had was back when I was doing property management. The way how it was arranged, just basically I have my broker, and then I was running my company under them, essentially almost like a franchise business. Mm-hmm. But I got in business with the wrong kind of people. So that would be my biggest lesson, is you got to be really careful about who you do business with.
Right.
And if you bring somebody into your business, I would highly recommend that you do it in a way so that it doesn't affect everything else that you've done prior. So if you have an operating business, don't bring in a partner into the business that's already operating. Create a new venture with them, and make sure that they're invested. And if you do an LLC agreement, make sure that if somebody, for example, doesn't do any more work, that you can buy them out or mm-hmm. something like that. You always got to have an exit plan. And there's books on that. So
I think that's so true. And just making sure that you have all the back end stuff, like your legal documentation in order, to make sure that if something goes awry, you have those levers to pull in order to either buy out a partner or get to conflict resolution. I think it's really important.
Or even if sometimes it's just somebody, you know, they die or they get incapacitated, you know, what's going to happen. And so there's a book called Business Buyout Agreements. And that has like everything. And that was a really great book.
Fantastic. And Noe, I know we already just covered where people can reach you, but just for one last time before the end of the show, where can people reach you? Your website or YouTube and or email address if people want to reach out and have a chat to you about, you know, getting you involved in their day-to-day underwriting in order to scale their business.
Sure. So if you want to reach me by email, I would recommend you go on Reed's YouTube video, and just so that you can get my name, Noe Perrin. You can find me on YouTube. I also have a website, noeperrin.com, and on Instagram as well.
Fantastic. Well, I want to thank you, Noe, for jumping on the show today. I've been really looking forward to getting you on the show. And I just want to quickly summarize what we spoke about, because some of the big takeaway items for me, just listening to you talk, I think would be, having a really incredible presentation on the front end. It sounds easy and all that sort of stuff, but having a business plan and making it where it's maybe audible, or not audible, but automatic in a systems process type of way, where you can, print off your underwriting in a way that creates a business plan that you can present to an investor. And what you said, you don't judge a book by its cover. It's really important to lead with that first, your best foot forward. I think also another big takeaway that I've written down here is the sensitivity analysis, and it goes back to that professionalism and making sure you've uncovered every rock or stone in order to show an investor in your financial underwriting, you've thought of all the possibilities. And again, it's not we create these models not to be a crystal ball, but in order to project our projection of the future. And I guess the last thing is also understanding the difference between cap rates and exit cap rates and entry cap rates, and the difference between interest rates and what forces that up, which is a big defining moment, or not a big defining factor when you come to exit a deal, and how the profits are affected for their investors, and understanding what is driving interest rates and how you as an investor need to reduce risk in your underwriting. Did I leave anything out?
No, I think that summarizes very well what we were talking about.
Cool, man. Well, again, thank you so much for dropping by. Enjoy the rest of your week, and we'll catch up soon.
All right, Reed. Look forward to it.
Well, there you have it. Another great episode, jam-packed with some incredible actionable advice and takeaway tips. There was some incredible golden nuggets on there. And I want you to go up onto our YouTube channel, or head to my website, which is reedgoossens.com. Click on the podcast tab, and that will take you to all the show notes from today's show. If you do want to reach out to Noe, remember it's noeperrin.com. Thanks again for taking some time out of your day to tune in to continue to grow your real estate investing knowledge, because that's what we're all about here on this show. We want to continue to grow your financial IQ, and hopefully my guests are inspiring you to go out there and take some action. Until next week, we'll do it all again. So take care, be safe, and remember, happy investing.